So a few weeks ago, the Commodity Futures Trading Commission issued this no action for swap dealers dealing with pre-trade mid-market disclosures. Now, one of the things that a lot of people misunderstand about CFTC no action letters versus SEC no action letters is that you can rely on somebody else's no action letter at the SEC, but not the CFTC. What do I mean by that? Well, at the SEC, 144A is used very commonly for institutional buyers to change their unregistered securities to registered securities. A very common transaction on the security side is called an Exxon Capital transaction, and it under Rule 144A, where a institutional buyer will take their unregistered securities and trade them to registered securities. It's a safe harbor. The reason it's called an Exxon Capital offering is because decades ago, Exxon Capital wrote in for a no action letter. It was issued, and now everyone relies on Exxon Capital's no action letter, even though it was issued to Exxon Capital. But with the CFTC, when the commission issues a no action letter, it is only for the person that it was issued to, no one else. So if you see a no action letter and you have the exact same facts, you can't rely on somebody else's no action letter. You have to write in for your own no action letter. There are very few exceptions to this, and this letter we're going to talk about today is one of them. So three very large trade groups, ISDA, SIFMA, and the Institute for International Bankers, requested this no action relief dealing with pre-trade mid-market mark on swaps. And normally, if a trade group writes in, the no action letter could apply to all members of the trade group, but this is very unusual in that it applies to everyone, not just the members of these trade groups. But if you see another no action letter somewhere, remember, even if your facts perfectly match that no action letter, you have to write in for your own no action letter. Unlike at the SEC, you can't rely on somebody else's no action letter. So this was issued by my old boss, Tom Smith, and by Frank and Jake, my former coworkers. Hope you guys are all doing well. So what's the difference between a no action and an interpretive letter? An interpretive letter is like the opinion we discussed earlier on. An interpretation is something that applies to everyone, and where there is some ambiguity in the statute, staff at the commission is saying, this is the way we read that statute and it would apply to everyone. However, no action letters generally apply only to the person that they're issued to, and the difference between an interp and a no action, an interp is saying, this is the way we read the statute. A no action letter is saying, you want to do something that is technically not allowed by the statute or the rules, and we can't change the statute, but we will not recommend this to enforcement if we see it. So here's an easy example to understand for no action. The CFTC required hedge funds to give audited financials to all their investors. And eventually, hedge funds started using something called a master feeder structure, where instead of having one fund, for tax reasons, you would have one fund with the taxable investors and a different fund with the non-taxable investors, such as nonprofits in the US and foreign investors who don't pay US taxes, and then just have the master fund trade. And then you'd have the master fund trade for both of these, and these would give money here, and then the funds would flow back. But because the rules said you had to give audited financials to all your investors, these people weren't just giving it here, and these people weren't just giving it here. But under the rules, this master fund had to give disclosures to these people, which they also own. So they would have to prepare and submit audited financials to themselves, which seems like a waste of time and money. So they would routinely ask for no action relief, and they would get it. And each of them would have to write in for their own relief because, as I said, you are not allowed to rely on somebody else's disclosures. You're not allowed to rely on somebody else's no action letter. But an interpretation applies to everyone. And this is one of the rare no action letters that you will see that applies to not only the people requesting it, but everyone. So during the great financial crisis, the era of the big short, swaps were not regulated, and therefore it was sort of the Wild West, and Congress, in its attempt to rein that in, set some broad guidelines, gave the commission jurisdiction to enact rules, and here we are. And one of those rules which I was a drafter, was the external business conduct standards for swap entities. And this is a no action letter that will grant relief for one of those requirements dealing with pre-trade mid-market mark. So at the time, there was lots of news articles about large investment banks raking municipalities and pension funds over the coals, making them sign or having them sign swap deals that they didn't understand. And so there was an emphasis on disclosing terms and conditions in a way that they would understand. And one of them is the pre-trade mid-market mark before you enter into a swap. So in very efficient markets, there's a very narrow bid-ask spread, and you're getting charged generally a number in the middle. And in inefficient markets, there's a very wide spread, and you're getting charged a number in the middle. And so when you're talking about swap dealers dealing with other swap dealers, this wouldn't apply. But when you're talking about a swap dealer dealing with certain counterparties, they would have to disclose this pre-trade mid-market mark, which would allow them to see the price they're paying and the halfway price between the bid and the ask, which in theory would allow them to make more educated and informed decisions about what they're doing. And to be fair, over time, as the markets have grown and become more efficient and information is more readily available because it's put out through the swap execution facilities and the designated contract markets, and you can see executed trades at whatever prices, the need for this has sort of become less important, and that's why this letter was requested and it's being granted. So there are times when you'd have to disclose it and times when you wouldn't, and it doesn't apply when it's on a designated contract market or a CEF, and when you're dealing with a person who you don't know the identity of. So if you're executing on a DCM or a CEF, you don't know who's on the other side. They can transact with you at this price and so can anyone else, and so there's not really a need to disclose that. And that's already contemplated by the existing rules. So because DCM and CEFs routinely trade these products now, and there are third-party providers who routinely make information about executed prices and bid-ask spreads available to everyone, this information is a lot easier to find now than it was 10 or 12 years ago. And as a result of that, if you don't comply with the pre-trade mid-market mark disclosure requirements, that's going to be okay. The division won't recommend an enforcement action based on failure to meet that requirement. And as I said, if the statute says one thing, this is about the most they can do. And if the statute is broad, but this applies to the specific requirements of a regulation, they would refrain from making the same referral to enforcement, and they would probably change the rule eventually. And it's important to note that even though you don't have to disclose this piece of data prior to the swap, the difference between the price you're executing and the mid-mark, which is the halfway point between the bid and the ask, after you engage in these swaps with a person, you still have to provide them the daily mark pursuant to CFTC Regulation 23-431D. So with regard to the daily mark from cleared swaps, you give them the number that's provided. So for cleared swaps, you can give them the mark that's arrived at by the derivatives clearing organization. And for uncleared swaps, you can give them the number that you use based on your model, but more likely the number that's based on the model that's used by a third-party provider that you contract. So again, this alters what you have to provide prior to executing the swap. It doesn't affect what you have to do after a swap, which is provide the daily mark. If you have any questions or comments about this, just put them below. If you think I'm wrong about this or disagree with anything I've said, all I can say about that is,
go outside, nerd. Get out. Go. I ain't got time to be distracted by your worthless chime-ins. Go on. Go out.
If you'd like to get in touch with me, just leave a comment below and I'll get back to you. Have a great day, everyone.